Hello everybody, today we are going to talk about the Fed cutting interest rates and the impact it will have on specific stocks, specific industries that will benefit, specific industries that will be destroyed. How should you invest to have a better performance in a new environment with lower rates? And we will do so reacting to this video from Khoo. Rate cuts coming, what's next for stocks and bonds? As I'm recording this video, we will have the final decision tomorrow if the Fed cuts interest rates, but it's a matter of time. If they don't cut tomorrow, it will come soon because of all the data we have, etc., etc. So I think we'll cover a lot of ground on this video. It's a 20 minutes long video. Take a cup of coffee, take some cake, take some whatever you want, and let's enjoy the show. In case this is your first video from this channel, this is not a React channel. This is a channel to make you a better investor. My name is Christophe Nour. I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year, listening to the gurus of this world, legendary investors, including Khoo. So it's a great inspiration, and that's the reason I want to share this video with you today. Okay, let's start now.
After holding interest rates at 4.5% for the last 9 months, the Fed is set to cut interest rates this week, at least 2 to 3 times this year and a lot more next year. So you will see the interest you get in your money market accounts in your bank fall significantly. But at the same time, how will this affect the stock market and the bond market, and which stocks and industries are set to benefit the most? Well, let's find out in this video. This chart shows you the Fed funds rate, which is the short-term interest rate controlled by the US Federal Reserve. Now, the Fed funds rate was close to 0% right after the COVID pandemic because the Fed had to stimulate the economy with very low interest rates. But then that led to super high inflation by 2022. And so the Fed had to raise interest rates super aggressively from near 0% all the way to about 5%. And of course, that caused the 2022 stock market crash, which turned out to be a bear market.
Yeah, a lot of people mention the European conflict when it comes to inflation and data, but just so you know, before the war in Europe, we already had some signs of inflation picking up at 4 or 5%. So this is not the only reason, right? The main reason for the inflation we had in 2021, 2022 was the printing of money to save us in this COVID environment, and for good reasons. I mean, you had so many uncertainties, so many lockdowns. The governments and Federal Reserves went safe, in a safe mode, and protected almost everybody, injecting a lot of liquidity in the economy. And it's about a supply and demand thing, so this creates inflation. And now they have stopped doing this, so inflation is trending down again.
The Fed held the interest rate above 5% for about 1 year. And then in September of 2024, when they found that inflation was under control, they started cutting interest rates by about 1% or 100 basis points. They had 3 cuts, and they cut it all the way down to where it is today, at between 4.25% to 4.5% target rate. And the average rate now is about 4.33%. But it's held it there for the last 9 months. And now there's a 100% probability, as you can see over here, that they're going to cut the interest rates by 25 basis points or 50 basis points on the 17th of September. And they're going to do 2 more cuts this year and a lot more cuts next year. And the target is to bring the Fed funds rate down to 3% or less by the end of next year. Why?
Yeah, we will see. We will see. As I'm recording this video, it's September 16th, so I have no clear verdict here. We are not 100% sure, but it's very likely they cut rate. We will see if they have something else to add. Yeah, actually, you have some companies that are using this chart, decisions of the interest rates, and they are doing smart capital allocation decisions about this. Maybe I will release a video about this. How do companies do buybacks using debt, taking advantage of the volatility in interest rates? That's a very interesting topic, very niche topic. It will not bring me a lot of views, but I think it will give you a lot of value for you, listener.
And finally, cutting rates. No, it's not because of Trump's nagging, although it could be a factor. The real reason is because data has recently showed that the US economy may be showing some cracks. So they are preempting that by starting to lower interest rates. Think of the economy like a car. So the Fed, they want the car to go at an optimal speed, not too fast and not too slow. And the Fed controls the speed of the car using interest rates. So whenever the Fed raises interest rates, it's like they're stepping on the brakes to slow the car down. When they cut interest rates, they're stepping on the accelerator to speed the car up. In 2022, when the car was going too fast, what happens? The car overheats, you get inflation. And so the Fed had to raise interest rates, step on the brakes to slow the car down. So that is what caused the 2022 stock market crash. Market crash because the market was afraid that the Fed was stepping on the brakes too hard, that the whole car would stall and would not move anymore. But that didn't happen, right? There was no recession in the end. And so the market eventually recovered because they realized that, hey, the car is not stopping, the car is on a nice speed. Why is the Fed now expected to cut interest rates, to step on the accelerator? Because there's now concern that the car could be slowing down. But if you look at the recent data, GDP still looks pretty strong, right? Quarter 2 GDP came in at 3.3%. That's pretty strong. And if you look at quarter 3, the real-time tracking by Atlanta Fed is still 3.1%. So what's the problem? Looks like the car is still going pretty fast. The problem is in the employment data. The recent employment data shows that Americans are finding it harder to get jobs. So the analogy is kind of like you're beginning to notice that the driver is kind of like falling asleep and the car may slow down or may stall. So to wake the driver up, the Fed is now thinking better step on the accelerator to get the car moving again so the driver wakes up and the car won't stall. So on Friday, the 5th of September, we had some jobs data that was a bit concerning. So what happened? Well, revised data shows that the US economy lost 13,000 jobs in June. This is the first month of job losses in 5 years. The last time when there were job losses in a month was December 2020 during the COVID pandemic.
Yeah, quick comment here. Maybe he will address this point later, but it's quite likely these numbers are fake now. I mean, you have so many adjustments for everything, and you had a little bit of a drama with Trump firing somebody, giving the figures, and you all know that Trump wants lower interest rates. It has been the case for the first mandate between 2016 and 2020. So he desperately wants lower interest rates, so borrowing is free, debt is free, and you can grow the GDP for the country, fair enough. He appointed somebody else. You have somebody that does the job and giving us the new figures for the labor market. And I've seen some very good articles saying that the data is likely to be manipulated, so the job market appears weak, so the Fed can cut interest rates. I think Jerome Powell and the Fed, I think they are aware of this, the potential manipulation from the US administration, and they have to make a decision, a tough call, and everybody is waiting for the Fed, for Jerome Powell to do something. So actually it's not that easy to lower interest rates, but that's just the dynamic we have. Just so you know, guys, don't blindly trust the figures we will have from the labor market. From the articles I've seen, the labor market is way more fine than it appears. Apparently, this is lowering, and we are decreasing the number of jobs in the market. And the truth is a little bit different, I would say.
And at the same time, you can see that the US economy only added 22,000 jobs in August, which was way below the expectation of 75 jobs being created. At the same time, the unemployment rate went up to 4.3%. Now, an unemployment rate at 4.3% by itself is not bad. It's still within the okay zone. But if the unemployment rate continues to go up and the jobs begin to be lost, then that could lead the economy into a recession. So we're not there yet, but it could lead to a recession if this continues. It's kind of like the driver is falling asleep. That could lead to the car slowing down and stalling. So the Fed is now saying, okay, let's step on the gas to get the car moving again. A common question I've been getting is, Adam, Usually when the Fed starts to cut interest rates, how does that affect the stock market? Does the stock market go up or does it go down? Does the economy get worse or does it get better? The answer is it depends on why they're cutting, and are they cutting too late or are they cutting just in time? So generally, when the Fed lowers interest rates, generally that's good, right? Because that lowers borrowing costs, which means that as a consumer, you can now borrow money at a lower interest rate, so you spend more money, that increases consumer spending. Companies can borrow money cheaply, so businesses can invest and spend more, and all this leads to increasing corporate profits.
Yeah, I mean, the best idea that will benefit from lower interest rates is FICO, Fair Isaac. They have a lot of debt and they are using a lot of debt to do buybacks. So if you have cheaper debt, they will take on more cheaper debt to do more buybacks. And additionally, they are in the mortgage market. They provide the FICO scores. So if the individuals, if the inhabitants are taking on more individual debt, personal debt, to have a mortgage, a new house, a lot of people were waiting for lower rates. If they are taking on more debt, they will need more FICO scores. So FICO will make more money, more revenue.
Lower interest rates also mean that when you value companies using a discounted cash flow valuation model, it increases the intrinsic value of the companies because of lower interest rates. So generally, it is good. However, it is when they cut and why they cut that makes the big difference. So if the Fed is cutting rates because it's already a recession, or it's coming close to recession, that's called a recessionary cut, then that is not usually very bullish. And when that happens, as the Fed cuts interest rates, the stock market will go into a bear market for at least 6 months to 1.5 years. So this was an example of what happened in 2000, right? You can see over here in 2000, when the Fed realized, oh shit, the car is really stalling, we are going into recession, and they start to step on the gas, it's a bit too late. Because when you step on the gas, it takes time for the car to react. So when they started cutting interest rates here, you can see that the market still went into a bear market for almost a year and a half.
That's a very good point. If you are cutting rates too late, you enter panic mode. The US is already in a recession. This is too late. The car will crash. Now, remember what I just said 5 minutes ago. What if the data about the labor market is rigged? What if it's fake? How do you make a decision if you are Jerome Powell right now? I mean, you can't really trust a lot of the data. So will you really make a decision or not? You want to play safe. You will maybe be a little bit early to cut rates. Yeah, I mean, this is not the first time they cut rates, right? Even in 1 year ago, they cut rates by 75 points, which means 0.25%. And it was heavily discussed. They don't have the true data. They have the same data that we have. So it's kind of hard for them to make a decision. I see a lot of people blaming the Fed, but actually that's a very tough job to do. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
That was the 2000 dot-com crash. Same thing in 2008, 2009. That was the great financial crisis when the real estate market collapsed and the Fed said, oh shit, the economy is in a recession. They start cutting interest rates over here. By the way, this color means they're cutting interest rates. You can see when they cut interest rates, market collapse. When they cut interest rates, market collapse. So people think that when they cut interest rates, market collapses. It is not the cutting of the rate that collapses the market. It is the fact that the market is already collapsing and they're cutting the rate to save the market, but it's too late. The market's really going down. So it takes a few months or a few quarters for the market to eventually rebound, for the car to start moving again after stalling. All right, so that's called a recessionary cut. But in this case, it looks like it is not a recessionary cut because again, GDP is still strong, industrial production is still strong. So right now it looks like a maintenance cut. So maintenance cut is when the Fed cuts rates when the car has not yet stalled. The car is slightly slowing down and they accelerate, and hopefully the car will move again without stalling. So maintenance cuts, a good example would be in 1995. Maintenance cut.
Yeah, basically, when you cut interest rates and we did not enter panic territory, this is what he calls the maintenance cut, and it is fine. When you have a clear panic like we had in March 2020 with COVID and you cut rates, that's a little bit different. You enter panic territory.
Cuts. A good example would be in 1995. Here, 1995, right? So they did a maintenance cut and the market continued to be very, very bullish. Over here, they did a maintenance cut, market was very, very bullish. Here, they did a maintenance cut, market was very, very bullish. So it all depends on whether it's a recessionary cut or a maintenance cut. In this case right now, looks more like a maintenance than a recessionary for now. So for now, I see the market more like 1995, a maintenance cut, rather than 2000 and 2008, which was a recessionary cut. So 1995, what happened? Same thing. The employment situation was slowing down, and again, jobs were declining, right? There were job losses, as you can see. Monthly payroll growth turned negative, and at that point, the Fed cut rates. The Fed stepped on the gas. So if growth and hiring re-accelerates from the combination of interest rates cuts, Trump's tax cuts, and the full expensing of business investment, then that would be very bullish for stocks. And you can see exactly what happened in 1995. The job growth re-accelerated and the stock market was very, very bullish.
Yeah, actually, this is a very interesting topic. And we have discussed this with clients inside the coaching program last week, that the situation today is very reminiscent of what we had in the dot-com bubble prior to the dot-com bubble. Many innovations, many new headlines with bigger amounts of money. You have all seen Oracle and their backlog right now. I mean, big tech giants are making big promises. Let me put it this way. And actually, the difference is now they are making money. Now they are profitable. But the growth will likely accelerate in the future. So we'll see if we will have a crash like the dot-com bubble. So far, the direction is the same. You have a lot of euphoria. In the past, it was the internet. Now it's AI. A lot of euphoria, a lot of spending. At the same time, the Fed is cutting interest rates. The goal is to grow out of this debt. Grow out of this competition with China and Europe. The US wants to be the leader at all costs. You have tax cuts and you have a US president that is pro-business, that is inviting all the AI leaders in the Oval Office or something like this to do a giant dinner, asking them how much they're willing to spend in the US. So yeah, definitely feels like 1995. We'll see. It doesn't mean that we will have a crash next year, but maybe in the next 5 years, I mean, it can't go up like this forever. Things will normalize eventually. So yeah, we are maybe a little bit early for a major crash, but the major crash will happen.
So for now, that seems to be the situation. Credit goes to Carson Research, who put together this table. And right now, notice that the markets are near all-time highs. And the Fed is cutting interest rates while the market is really, really high. And people are saying, but isn't it concerning? The market is so high and they want to cut interest rates. Won't that cause a bubble? Now, has this happened before? Yes, it has. And these were all the times when the Fed cut interest rates when the market was already near an all-time high.
This is a crazy table, by the way. Thank you, Adam, for sharing this with us. This is a crazy table.
2%. So these were all the times it happened. It happened 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. It happened 22 times since the 1950s. And in those times, what happened to the market? Well, right after the cut, in the next 30 days, was the market up and down? Well, it was a coin flip. You can see that half the time it went up, and half the time it went down. Over the next 3 months, the market was up 77% of the time. But over the next 1 year, the market was up 100% of the time with an average return of 13.9% and the median return of 9.8%.
Okay. So now on this channel, we don't focus on short-term things. So please disregard the next month, next 3 months, next 6 months. What is important is the next year. Every time the Fed cut interest rate when the markets were all-time highs, every time it went up, going up, it continued on the way up, which is a crazy table. I mean, if history is a guide here, if you don't have any years that this table disregards and forgets, this is extremely bullish. Be always careful when you see this, but it increases the odds of happening.
So what does this mean? So this means that in the next 30 days, there's a 50% chance the market will go up and a 50% chance it's going to go down. Now, if you ask me, my guess, I think in the next 30 days, the market will go down. How much, I don't know. But I think it will go down in the next 30 days. Why? Well, there are two reasons. The first reason is because, again, this is a seasonally bearish period of the year, right? September tends to be bearish. September tends to start out strong, but towards the end of September, the market tends to sell off. Again, this is seasonality. So that's one reason. Now, the second reason is simply because the market looks a bit overextended on the short-term charts, right? Or the short-term price action. So again, remember, market doesn't go up in a straight line. The market will always go up. It just doesn't go up in a straight line, right? So it moves in wave patterns. You can see wave up, wave down, 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 wave up, wave down. Now it's going on a wave up pattern. So when will it wave down? I can't predict. Could be tomorrow, could be on Wednesday, could be next week. I don't know. But there's a high chance that after waving up, it's going to wave down. Okay. So does this mean that I'm going to short the market and predict the wave down? No. Am I going to sell any of my stocks and let it drop and buy it back? No. Because I can't predict exactly where's the top and I can't predict exactly where's the bottom. So as long as I hold on to great companies, I stay through the ups and downs. But what I will do is once the market waves down, I'll use that opportunity to add more shares of high quality companies once they get undervalued. Once they go below the intrinsic value, they go to the support levels, I'll start adding shares. At the same time, once the market waves down, the VIX, the volatility index goes up, premiums become very attractive. So that's when I like to sell cash secured put options or put credit spreads to earn a lot of premiums. And then when the market eventually rebounds back in October, November, December, then those positions become very, very profitable. One thing to bear in mind is that everyone knows the Fed will cut rates on Wednesday. You know it, I know it, your grandmother knows it, all the traders and all the investors already know it, right? So the market already prices in all known information. So in a sense, people who are predicting the market will go up because of the rate cut, they've already bought into the market. So the market is already up based on the expectation, okay? And that's why I say when the Fed actually cuts rates, then the market could actually sell off from profit taking. Again, there's no guarantee.
Yeah, as you say, buy the rumor, sell the news.
But that tends to happen. But as the Fed continues cutting rates for the rest
Actually, what will happen, what is very likely to happen during tomorrow, I mean, well, you will have the information before me because you are watching this video after the decision is, I mean, that would be my guess. That's usually how it's happening. You will have the decision. People will judge if 25 or 50 points cut is warranted or not. And you will have more commentary from Jerome Powell regarding the economy, regarding inflation, regarding the labor market. And people on the internet will judge whether the words he is using are bullish or bearish. People are making such analytical, analysis of the words, the wording, the sentences, the tone of the voice, whether he says good afternoon or hello everybody or ladies and gentlemen. People overanalyze what he's saying, so it's all about short-term stuff. This is what we don't like to make short-term videos on this channel. The people will judge, and after 1 month they will forget and focus on the next data point. So if you're freaking out, please don't. Anything can happen in the short term. The major things that are important are the labor market and the inflation rate. This is the things to monitor, right? If inflation stays stable or rather down, and the labor market stays fairly stable or rather down, this is an environment where you can expect more rate cuts. And over the next 2 weeks, for the remaining part of September, we will see. We will see what will happen.
Of the year and next year, then after the initial sell-off, the market should continue to rebound. So, which industries are going to benefit the most from a rate cut cycle? The first beneficiary, obviously bonds. So as you guys know, bond prices move opposite of interest rates. When interest rates go up, bond prices go down. That's what happened in 2022. In 2022, when the Fed raised interest rates so aggressively, the biggest rate hike in 40 years, what happened to bond prices? Bond prices crashed, right? Both treasury bond prices and corporate bond prices. So now, if the Fed cuts interest rates consistently for the next 1 or 2 years, bond prices should have a nice rebound. Already you can see bond prices already beginning to price in the rate cuts. Now, one of the simplest ways to get exposure to bonds would be bond ETFs. So for example, you can look at some treasury bond ETFs like the IEI, which is the 3 to 7 year treasury bond ETF. And you can see again in 2022, when the Fed raised interest rates aggressively, what happened to the bond? The treasury bond ETF, it collapsed, right? Went into this huge bear market, and then it kind of like went sideways for the next couple of years. And now we can see it's beginning to have a slight reversal in trend, where it's now wave up, wave down, wave up, wave down, wave up, wave down, wave up. It's beginning to slowly get back to that uptrend. This is the 3 to 7 year treasury bond ETF. Or you can look at corporate bond ETFs like the LQD. So this is the corporate bond ETF, and same thing. You can see again when interest rates go up, goes down, right? And then when interest rates were held steady, it kind of like goes sideways, and now that rates are beginning to fall, it's beginning to reverse back into a new uptrend. So this is at the early stage of a new uptrend. You can also look at bond funds, closed-end bond funds. One of my students recently, talked about one of the bond funds, which I thought was pretty interesting. I may start to take a stake in it, not because I'm looking for capital gains, because I can get capital gains by growth stocks, but more for yield, because this is offering about 10% dividend yield with potential upside as rates come down. So the ticker symbol is PTY. This is the PIMCO Corporate Opportunity Closed-End Fund. So you can see again, when rates go up, the bond fund collapses, then goes sideways, and as rates come down, we should see this begin to rebound. And again, you also get a nice 10% dividend yield on this as well. Next big beneficiary are obviously REITs, Real Estate Investment Trusts. So I hold quite a number of REITs actually in my dividend portfolio, but I tend to buy REITs listed on the Singapore market because there's no dividend tax and they tend to have higher dividend yields, plus they've got lower gearing ratios. But whether is it Singapore listed REITs or US listed REITs, REITs benefit with lower interest rates. Why? Because REITs, they take loans from the bank in order to purchase.
Yeah, REITs are known, all the real estate investments are known to need an excessive amount of debt to fuel their operations. Same thing, he will talk about real estate and housing related. All the home builders can go two ways. Either you buy options before buying the land, or you take a lot of debt to buy as much land as you can. So all these housing industry, real estate industry relies heavily on debt. If the debt is getting cheaper, that's very good news for them.
Just the real estate. So when rates come down, their cost of funding reduces. At the same time, property valuation increases as cap rates go down, and with lower interest expenses, their net property income will go up, their adjusted funds from operations will go up, and their dividends per share will go up, and of course the stock price will go up. As you can see, many of the REITs, have already begun to increase in price as they price in the expectation of the Fed lowering interest rates. Now, of course, for Singapore-listed REITs, those with more Singapore assets, they would already have run as Singapore rates have already come down. But those with more overseas assets, they are starting to increase in price as they factor in the drop in US interest rates. You can see, for example, CapitaLand Ascendas REIT that has both Singapore as well as overseas properties. You can see the price from dropping in 2022, again going sideways as the Fed held rates, now beginning to rebound. And now, in fact, it's slightly above its fair value, but you're still getting more than a 5% yield. Another example would be Fraser's Centrepoint Trust. This only holds Singapore assets, so it has really started to rebound as Singapore rates have come down. But again, there should be more upside as rates begin to come down even lower. Another example would be CapitaLand Integrated Commercial Trust REIT. You can see this has already gone above the fair value, and you're getting less than 5% yield. So I would wait for a bit of a pullback before adding more to this REIT. So generally, REITs will benefit from a rate cut cycle. Thirdly, obviously, real estate and housing related stocks will benefit as well, besides REITs. Why? Because with lower rates, lower mortgages, that could spur home buying, that would be beneficial for home builders as well as related industries, whether it's in Home Depot or Lowe's or Pool Corporation, where they sell swimming pools. Again, you can take a look at individual companies that are high quality. You can check them on Stock Oracle to check about how profitable they are, or simply can just buy the ETF. So for example, one ETF would be the Home Builders ETF, which is the XHB. You can see how it's affected by interest rates. Once again, in 2022, when the Fed raised interest rates aggressively, what happened? XHB sold off. Now, it's important to bear in mind that it's not really the short-term rate that affects home builders directly. It is actually the long-term interest rate that affects mortgage rates. So when the Fed raised the short-term rate, the longer-term 10-year rate went up in 2022. That caused home builders to sell off. Then once the Fed paused the rate increase and the 10-year Treasury yield held steady, then the XHB recovered. But then what happened in 2025, early 2025, when Trump started his trade war, that caused a lot of concerns over inflation, that increased the 10-year Treasury yield, and then it sold off again. But now the 10-year Treasury yield has stabilized and the Fed is looking to cut rates, so the market is pricing in a rate cut cycle. You can see the XHB again now beginning to recover from that. And again, you can look at individual companies as well. So examples would be Home Depot or Lowe's, and by the way, I happen to own Lowe's. It's one of the stocks in my portfolio.
Yeah, you can also check Pool Corp. This is fine. Pool Corp, I was an investor in Pool Corp and I sold the position, but maybe it will get interesting again. It will get pretty interesting soon, maybe with lower interest rates. And you have all the stocks related to the home building equipment. Same thing. All the discretionary stocks like Toro, for example, Sherwin-Williams to some extent with the painting. You have all the home builders like Toll Brothers, Pult Homes, NVR, Green Brick Partners. Everybody will benefit. Everybody will benefit.
And you can see it's already pricing in the rate cut cycle. You can see Lowe's is already beginning to go up. And it's a bit overvalued right now, so I wouldn't jump in right now. But it was a great time to add when it was near all these support levels. Remember, I always buy after a wave down and never buy on a wave up. All right, so you can see wave up, wave down, buy. Wave up, wave down, buy. Wave up, wave down, buy. Now it's on a wave up. I never chase the girl. I wait for it to wave up, and then if it waves down again, then I buy it again, right? So you can either trade it, you can invest it. There are many ways to play this. Next beneficiary would be consumer discretionary stocks. Why? With lower interest rates, people make lower interest payments, they have more disposable income, so they tend to spend more on higher priced non-essential items. So what are examples of consumer discretionary stocks? Well, you can go on to Finviz and look at their heat map. By the way, Stock Oracle will be coming up with our own heat map pretty soon, and it's going to be really powerful because it's going to include the economic mode as well as whether it's overvalued or undervalued. All those are in the plans. Not right away, but Stock Oracle will have all these exciting upgrades to come.
By the way, I don't have much feedback about Stock Oracle. If somebody is using his website, his platform, Adam's platform, please let me know in the comment section below. If any of my viewers are using Adam's platform called Oracle, it should be good. I mean, Adam is a great teacher, so the platform should be great.
Anyway, if you go to Finviz and you look at consumer cyclical, which is the same as consumer discretionary, you can see the type of stocks that will benefit from, again, higher disposable income. So these are companies like internet retail companies, your Amazon, your eBay, your DoorDash, for example. But again, bear in mind, do check with Stock Oracle. It's a high quality company. If you ask me, obviously.
Finviz is a free website, by the way. You don't need to pay to access Finviz. They have a small screener and most importantly, this table, this chart, this heat map every day with the performance.
My favorite is Amazon. That's one of the highest quality consumer discretionary companies. And then you've got auto manufacturers, which I personally do not touch. But of course, leading the list would be like Tesla, for example, for those of you who want to books. You have got your consumer cyclical auto parts, which I own AutoZone. I've owned AutoZone for many, many years. And in fact, it's one of my best performing stocks. It's a very quiet stock. No one talks about it, but slowly and surely making gains very consistently.
I'm also an owner of AutoZone. It's my second largest position, and I've also had great gains with AutoZone. What is great is they will benefit because part of this industry is to rely on customer spending. If the debt is getting lower, people will have more money because they will have access to debt. And this is why AutoZone is performing so well this year. And additionally, AutoZone is taking a lot of debt to fuel buybacks. So if the debt is getting cheaper for this company, similarly to Fair Isaac, FICO, they will take more debt to do more buybacks. And that's very bullish for the earnings per share and the stock price.
Restaurants, travel stocks, like for example, I own Booking.com. You've got residential construction, which I don't touch. You've got footwear accessories like Nike. I do have a small position in Nike, by the way. You've got specialty retail. You have got resorts and casinos, which I don't touch as well. So all kinds of consumer discretionary stocks that would benefit from lower interest rates. But again, you have to buy the high quality ones and do check with Stock Oracle, the ones with the highest.
What would be interesting is now that we will go into a lower interest rates environment, what are the companies that are now debt-free, now that they will take advantage of the cheap debt to make aggressive share buybacks financed by debt? An example I have in mind is Lululemon. Very cheap, very hated in the market. Maybe the worst performer this year of the S&P 500. Lululemon is down, Lululemon is cheap, Lululemon is still growing. They have issues, yes, but you come to a point where sometimes the management team has to make a decision. And this decision may be to take on more debt to start a huge buyback program. It will be pretty interesting to see not only Lululemon, but plenty of other companies in this category that will take advantage of the volatility of a low stock price to start a huge buyback program. It will be pretty interesting, actually. Looking forward to seeing the moves in the next 1 or 2 years.
Predictability, the highest profitability, the one with the strongest moats, the one with the highest financial strength, and the ones that are undervalued. Those are the ones that we want to focus on. So again, for example, AutoZone, which I own in my portfolio for a number of years, this is a high quality stock, right? It's got high predictability, it's got medium profitability, medium growth, a very strong economic moat. It's got medium financial strength, but it's currently overvalued, right? That's why the valuation is low. So I wouldn't buy this right now, but if it gets undervalued, I'll add this stock. Another example of a high quality stock, which is within consumer discretionary, which I own, again, is Booking.com, which is the world's largest travel agent. And again, same thing, you can see, very predictable, profitable, pretty strong growth, strong moat, strong financial strength. But again, currently it is overvalued, So you got to wait for the wave down pattern. And I said, what waves up will wave down. Once it waves down below intrinsic value, that's when I will add to my position.
What he's saying is a great advice, meaning the markets go up and down by waves, and now we are on the wave up. So maybe buying now, if you want to time the market a little bit, because I don't know, maybe you are greedy. If you want to time the market and wait a couple of weeks, he suggests to wait a couple of weeks when the markets go down a little bit, so you can buy.
So I wouldn't chase it right now. Like I said, wait for the wave down. Finally, small to mid.
And this is another positive of being investing for the long term and never trying to time the market, right? I will not buy, I will not chase because I don't have cash right now. I'm fully invested and I just hold on to my positions. Doing nothing, inaction is also an action. Strangely enough, doing nothing is a conscious step to outperform the market. The safe zone is to do nothing right now.
Cap stocks as well as speculative growth stocks.
Yeah.
Now, bear in mind that these last two categories are much riskier, right? So small to mid cap stocks are much riskier. So I personally do not buy them individually. I rarely do. I would only buy usually through an ETF, like a small cap ETF, like the Russell 2000 ETF, like the IWM, which is already beginning to rebound. You can look at the charts yourself. And finally, speculative growth stocks. These are usually companies that are not yet profitable, but there's a lot of growth in the revenue. I tend to avoid these because they're very risky, but I do buy some of them when they turn profitable. Like I bought Palantir when it just turned profitable in 2022. I bought Celsius when it turned profitable. So I rarely buy them, but when I do buy them, I do want to make sure they turn profitable as well. But again, these speculative growth stocks tend to benefit a lot with lower interest rates.
Yeah, basically when you are in a fantasy land with easy money, small business models that are growing a lot with a lot of debt will benefit. That's a huge risk that I never want to take, and I don't recommend my students to do this because a lot of them came to this coaching program having burnt. They were burnt before by chasing these speculative growth stocks. It's not for everybody. I definitely don't recommend this kind of investing. It's not for everybody. It's very risky. You add a lot of stress and anxiety to your life, which you don't need. And I have never done this in investing in my own portfolio for almost 10 years. And I have generated 25%, avoiding the speculative growth stocks that are sexy at the moment. You don't need to be a genius and find the next Tesla, the next Amazon in speculative growth stocks. You can outperform the market if you play safe. This is also possible. I've done it.
Most of the time when I do buy speculative growth stocks, they tend to be more for short-term trading than long-term investment. Like recently I bought Oscar and it's now very profitable, but it's a short-term trade. I notified my UIP subscribers and I'm still in the trade, by the way. I've not taken profit on Oscar yet. So I hope that you've enjoyed this video, and as always, may the markets be with you, and I'll see you guys in the...
Okay, thanks for the video, Adam. Thanks for watching this video.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.